Okay, we're moving into Module 5, Chapter 8, where we're going to look at long-term assets. And in particular, we're going to look at 3 different types of depreciation methods, along with a couple of intangible items and how you similarly depreciate those. We don't call it those exact words. But we're going to first start off with what goes into the cost of even buying an asset. And it's very similar to what we've already done with inventory. It's the same rules. Any cost that gets that item ready to use is included in the cost of that asset. So if you buy a machine and if there's sales tax, that gets added in. If you have to pay the shipping, that gets added into the cost of the asset. There is no separate shipping expense. If you have to have it installed or buy some pieces and extra pieces to have it installed, that all gets included in the price of that equipment that you will then depreciate over time. So I just put a few items on here. The key thing here is any cost that gets that item ready to use. And then of course, if there's any returns, a piece of it is broke, you have to return it, or they give you a discount, you take that off of the price of the asset that you purchased. So then the next thing comes along is, well, what actually counts if you have to repair an asset? Do we count it as a normal repair expense and it's just expense for that year? Or if it's a big item for the car or whatever it is you bought, big item, do we need to add it into the car? Like an engine. If I buy a new engine for a car, that engine is going to last me more than just a year. So if it's going to last me more than a year, remember that way back to week 1, or I think week 1, maybe week 2, to have an expense, the expense has to last or happen now and only for up to a year. But a new engine is going to last you more than that. So what you have to do is you have to what's called capitalize that engine cost and put it into the price of the car. So your car value is going to go up, and therefore you're going to have to redo your depreciation for the upcoming years. Basically, if you buy something and it touches on one of these 3 things that I have highlighted, then you're most likely going to capitalize the costs. So if it makes the asset work longer, then that's going to be something that you're going to capitalize and you're going to depreciate it, do a redepreciation calculation. Makes it worth more, or if it changes its capacity, meaning like if you had a van that hauled stuff back and forth, but then you change that van into more of a passenger van, or you changed it into a security type outfit van, then that would be a major overhaul and changing its capacity. So therefore all the costs you would actually put into the van itself and depreciate it. So this is just to give you a little example of what I mean. Hopefully it's pretty clear and cut. If we answered yes to this, like if I bought a vehicle 2 years ago, paid cash, just as you would think, we would debit our vehicle, credit cash. And then if 2 years later I put in a new engine, I'm going to simply debit the vehicle again and credit cash. I'm not going to call that an engine expense or anything else. So I'm going to be increasing the value of my vehicle and then calculating whatever depreciation I need to do. So here's a couple examples. New engine, putting in a new transmission in your car, that's going to make your car last longer. It's a pretty hefty item. Could increase its value, but probably not. If you, for a building, if you put on a new room, you're actually putting on an extension, that would be one of those items. Something that doesn't really make the building last longer. If you painted a room, then you're not going to call that and debit the building. That's not a major overhaul. It's not going to make the building last necessarily longer. And then any other expense, keeping along the car train of thought, if you get an oil change, perhaps even get new tires, those are more wear and tear and normal replacement costs. You expect to do those to keep the equipment in good order. So therefore, those are just normal expenses and you do not capitalize it. You put that into the price of the vehicle. Okay, with land, land, The key thing, if you buy a parcel of land, and even if it has a building on it, what you're going to do with land is anything that gets that land ready to use. So if you have to tear down the building, whatever cost that is, that goes into your land value. If you have to level the land, get out some backhoe company to do that, that goes into the cost of the land. You don't keep those as separate expenses. If you have to, any other things, any legal fees that had to go along with getting the land, you're going to put that into the cost of the land. Now, the one big difference with land then is land doesn't depreciate. It stays its same value unless something actually happens to the land or there's some kind of maybe a dump gets put in right next to your property that's going to make the land go down, so you can revalue the land at that time and potentially take an adjustment. But that's beyond this class. We're not going to look at that. Just the key thing to remember is land does not depreciate. The exceptions are the buildings that go on the land. Those are depreciable items. Those are separate. And then any land improvements, those are also depreciable. Land improvements being if you put a fence along your property. That fence isn't going to last forever. It's going to wear down. The land, though, the actual dirt isn't going to wear down. It's going to be there regardless. If you put in a parking lot, that cement's going to break down and crumble away after a while. So that's going to depreciate. That's a land improvement. So we always want to separate out the land, the building that you put on the land, and then any land improvements. Those three things got to be separate. The one confusing thing then is the building that may already be on the land that you want to get rid of, that goes into the cost of the land as part of the raising. One of the things we're going to focus on in this chapter as well is just to show three different types of depreciation that companies can pick. Companies can pick any one they want. By far the most popular is the straight line depreciation. And then, of course, companies use, for tax purposes, tax has its own depreciation method called makers. And you'll learn a lot more about that if you take tax class. So we're going to look at the first one here, just kind of we already know how to do straight line, but we're going to add one little new twist to it called the salvage or residual value. Books use either term. So just look for either term, residual or salvage value. The straight line method, we know how to do this. We have to know their useful life because we're going to take the cost of that asset. And then what we're going to do is we're going to take and add that, or in this case, subtract this new item, the salvage value. So we're going to take the cost of the asset minus the salvage value. The salvage is what I plan on selling it for when I'm all done. So it could be zero. Maybe I'm going to use the equipment completely until it breaks down, and then I don't really have anything, and it's not worth anything. But if you're like a car rental company, think of Enterprise, they don't carry cars on their rental more than about 2 or 3 years. Those cars are still worth something after the 3 years when they trade in for new cars, unless they're just doing it like on a lease. But pretend they're not doing it on a lease. They just bought the car. What they're going to be able to sell that car as a 3-year-old automobile, and it's still worth something. So they do not want to depreciate it all the way down to zero. Because if they do that, then when they sell the vehicle, it's going to have a big gain. And then they're going to have to deal with gain and all the tax issues that go along with that. So it's best to get your depreciation and then therefore your book value. Remember book value, what that is from a couple of weeks ago. Book value is the cost of your asset, say 20 grand, less how much you've depreciated in total, the accumulated depreciation. So let's say you've depreciated 8,000 total throughout 3 years. Take the 20 minus the 8. So now you're at $12,000 book value. And that your goal is hopefully you can sell the vehicle for somewhere around that and then have a very little loss or gain. That's the whole goal. That's what, if you could have it just perfect. Now, if you sell it for more, great. You don't want to not sell it for more if you can. You're going to have a gain. You're going to pay tax on that gain, but that's fine. But you want to try to keep it as minimal as possible. Okay, so back to the straight line. You're going to take the cost of the asset minus the salvage value. That's going to what's called that's the numerator. That's the depreciable cost. And then we're going to simply take that depreciable cost and divide it by the useful life. That's what we already know how to do. It's just we added this one little new thing in here. Now, just to give an example, and we're going to use this example continue for the next couple of us when we look at the units of production. We're going to continue with this example, and then when we go to double declining, we're going to use it some more. So you may want to just jot down these items on a separate sheet. Just some of the date, when we bought it. So notice we bought it halfway through the year. That's going to be important. 19,000 is what we bought it for. It has a salvage value of $4,000, so I expect to sell it for that after I'm done, which says it has a useful life of 5 years. And I also ask us to prepare an amortization table. What that amortization table is basically a year-by-year listing of how much I depreciated that year, what's my total accumulated depreciation, which I could easily look at the T account to find if I wanted to for that as well. And then also, what's the current book value of that vehicle. So if I do sell it, I'll know what it's still worth on my books and if I have a gain or a loss. So the first thing we want to do is just figure out how much am I going to depreciate every year. So go back up to here to my steps. Step one, take my cost of the asset minus the salvage value. So it has a depreciable cost. That's what I'm going to depreciate it on, is $15,000. It's still on my books for 19. This is just what I'm using as my numerator. Take the 15 divided by 5 years. So that's $3,000 a year. And that would be great if I had it for a whole year, year one. But I don't. I bought it in July, halfway through the year. So if I only have it for half of a year, I'm only going to depreciate it for half the full year amount. If I would have only had it for 2 months, then I would have taken 2 divided by 12 and then taken that times 3,000. Just depends on how long I have it over that year. This is what it is for an entire 12 months. And then I would start my amortization table. So this is just a real easy to prepare amortization table. You could do this in Excel. I have my depreciation expense over here. Accumulated depreciation, how much total have I done, and then what's it still worth to me on my books. Now notice here the day one, the day that I bought it, I don't depreciate anything, of course. I just put what it's worth. The book value is $19,000. I do not use this 15. That was only for depreciation purposes. So my full cost of the asset is 19. After year one, the end of 2020, I've depreciated just a little bit. And so therefore my book value goes down by the 1,500. Now in year two, if I would do the journal entry again for year two, I would do the whole $3,000, because in 2021, I had it for the whole year. So 2021, my depreciation expense is $3,000. Total depreciation throughout the life is $4,500. And then therefore my book value, it was at $17,500. I took another $3,000 off, so I'm at $14,500. Then you'll see for 2022, with straight line, the amount of depreciation stays the same. That's why it's the most popular, it's the easiest. $3,000, tack on another $3,000 to my accumulated depreciation, and then simply take off $3,000 from my book value. I can go all the way down, and then you'll see that when I get to, so this is half a year, and then think of this as 1.5, 2.5, 3.5, 4.5. My last year, I have to do that last half a year because I did half a year up here. So a half a year at the end from January through July. And then notice where that puts me, right where I wanted it to be. My salvage value when I work this all the way through is just what I need it to be, $4,000, what I think I'm going to sell it for. So that's how that works with straight line depreciation. So then what happens if somewhere along the way, let's say here in year 2022, I sell the vehicle. I sell it before I thought I would. That's fine. That can happen. Happens a lot. We're probably then going to have a gain or a loss because I probably didn't sell it for exactly what it's worth on my books. So when you do sell a vehicle, the debit and credits are going to be, just ask yourself the same questions. What did the business get when you sold the vehicle? Well, you probably got one of two things. You either got money or a promise for the money later. And then your credit, you're going to then, why did I get the money? Well, you got it because you got rid of your equipment. So you're going to credit your equipment account. And then you're also going to get rid of its contra accumulated depreciation. But it already has a credit account. So this one you're actually going to have to debit. So you're going to get rid of your equipment as a credit, and then you're going to debit the accumulated depreciation because you want to get rid of it too, and it's contra. Then to balance everything out, we're going to have one of these two left. We're going to either have a gain on the sale or a loss on the sale of the asset. If I sold it for more than 11.5, and I'm just using that one as an example, if I sold it for $12,000, then I have a $500 gain. And gains, we're going to see, are always credited. Gains, think of those as like revenue. Gain and revenue kind of think of the same thing. They're not the same, but think of them the same. Gains are always credited like revenue, and losses are always expensed, or are always debited like an expense. Those gain and losses, they're actually not normal day-to-day revenue or expenses. Revenue and expenses are what we do to make money in our business. We don't sell our vehicle or our equipment to make money. That's just part of the business, but that's not how we do our job. So that's why those gain or losses actually go outside of even the expenses into a separate category in the 600 accounts. There's not too many things out there, but this is one of them. And they're usually on the income statement at the very, very bottom. Usually you're going to have a net income from operations, and that's going to be your normal day-to-day. And then you're going to have a net income after any gain or losses. Because gain or losses aren't something that happens usually. And your business really, you don't really want to judge your business based on your gain and losses. But it's still important because a company could make it so they depreciate something a whole bunch the first couple years, knowing that they're going to sell it, and then they've made their income lower for maybe tax purposes, and then brought it way high the third year when they sold it with a big gain. So that's why we still put them in there. All right, so we're going to go back to this previous example, and it says in 9/30 in 2022 we're going to sell the vehicle. So at the end of 2021, we have a book value of $14,500 and a $4,500 accumulated depreciation. So what you may want to do, and I think I'll put this into a T account. I think it may be a little easier to see if I actually show it. So we're going to get out the T account sheet. I would have the equipment here of 19 grand. That's what I bought it for back in 2020. And then remember that first year in 2020, I had 1,500 in accumulated depreciation. And then I had 4,500 in 2021. Now we're saying that in 2022, I'm selling the vehicle. And I got to note the date. The date is going to be important. I sold it 3/4 of the way through the year. So I don't want to use the full $3 grand when I'm depreciating, because I am going to depreciate when I'm ready to sell. I'm going to depreciate for that 3/4 of a year. So I'm going to figure up how much do I depreciate. If this is for a whole year, I had it for 9 months out of 12 because we're at the end of September. So I'm going to depreciate it another $2,250. So in total then, if I sum all this up, so $1,500, $3,000 for year 2021, $2,250 for year 2022. Now I'm at $6,750 accumulated depreciation, which is just what my updated amortization table says. So everything that I've just done over here, I can do in my amortization table. I've got a book value of $12,250. Okay, so if you just take this, how I got that, you just take the equipment minus the $6,750 total, and you get $12,250. Now it says I sold it for $11,000, so I'm selling it for less than it's worth on my books. Therefore, I'm going to have a loss if I sell it for less than it is on my books. Okay, so I know that this is going to need to be in my journal entry. So let's see how the journal entry works. So remember the debit, what did I get? It says up here that I got cash. So I'm going to debit the 11 grand. I then need to, I usually would put it down here, but I'll put it right here. I need to get rid of my equipment and my accumulated depreciation. So I'm going to credit my equipment for 19. I need to then get rid of its buddy account. So I need to debit for $6,750 to cancel that out. So that's my next step, is I'm going to go ahead and put in the debit for $6,750. And then I could skip a line and put in the cost of the vehicle, that 19 grand that I credited. And if I did that, then if I added up my debits versus my credits, they wouldn't balance. I'm a little shy over here on the debit side. That's where that loss comes into play. The loss is for that $1,250, treated like an expense. It's a debit. I'm going to show $1,250 here. And then if you add up all three of these, I get to where I want to be at 19 grand for the debit and the credits.